1 Bitcoin at 1 million by mid-June. That's the crazy bet Balaji Srinivasan made a few weeks ago. Even though it may sound completely absurd at first, in this video, we'll explain why this projection says a lot about the current monetary and banking situation. Let's get started. So for those who may not be familiar with him, Balaji Srinivasan is a highly influential figure in the crypto ecosystem, a renowned entrepreneur, former CTO at Coinbase, former partner at the venture capital fund Andreessen Horowitz, and holds a PhD in engineering from Stanford University. In short, he's far from being a joke. He's also the author of The Network State, a highly successful book that explains how new technologies will transform the face of nation-states. As a little anecdote, he's also known for eerily predicting certain aspects of the COVID crisis in early 2020, even before it became a global pandemic. So when Balaji says something, there are a number of people who listen. It all starts in mid-March with an individual calling himself James Medlock on Twitter, who has a fairly large following and self-proclaims as a hyperinflation doubter and social democrat. That gives you an idea of the character. On March 16th, he tweets that he wants to bet 1 million that the United States will not experience hyperinflation. Clearly, this tweet was more of a joke than anything else. And yes, if the United States doesn't experience hyperinflation, he wins his bet and pockets the $1 million. But if there is indeed hyperinflation, he loses the bet and has to pay a ridiculous amount, since $1 million would be worth nothing. And that's where Balaji comes into the picture. The latter takes the proposition very seriously and even decides to outbid it. The bomb is dropped. The terms 1 million against 1 Bitcoin, which was trading around 26,000 at the time of the tweet. If Bitcoin surpasses the $1 million mark by mid-June, Balaji will claim the Bitcoin. Otherwise, Medlock will win the $1 million. We then saw a wave of responses under Balaji's tweet from people wanting to join the bet. In fact, Balaji offered to take the bet against Medlock, as well as against another second person. So there are $2 million at stake. As some have pointed out, the goal is likely to generate even more noise and gain visibility. Because let's be clear, that's Balaji's real objective, to create buzz. And in fact, I believe no one wants Balaji to win his bet. If the dollar experiences hyperinflation and Bitcoin reaches 1 million within 90 days, the planet would turn into a scene from The Walking Dead. Chaos, riots, famines. If the dollar collapses that rapidly, it won't be a pretty sight. If you believe in such a scenario, it's better to buy weapons and canned food. You'll probably need those more than Bitcoins. In short, as mentioned before, Balaji is not just anybody. He knows exactly what he's doing. The objective here, as he himself states, is to draw public attention to serious and important issues. And we can say that it worked. His Twitter thread has been viewed over 13 million times, and Balaji gained 100,000 followers in the week following his post. To my knowledge, nobody really knows if the bet will actually be honored or if it was purely theoretical or for entertainment purposes. By the end of March, they apparently had some minor technical difficulties in finding a trusted intermediary. But Balaji seems determined to see it through. Now, as mentioned just before, the main purpose of this bet was to alert as many people as possible to the current monetary and banking situation. The house of cards in the fiat system is trembling and in a very worrying way. For those who haven't been following, the market has been flooded with liquidity to deal with the anti-COVID measures. Many banks found themselves sitting on a mountain of cash, which, let's not forget, belongs to their clients. Instead of letting this money sit idle, they did what they always do. They took it and converted a significant portion into U.S. Treasury bonds, meaning they lent it to the U.S. government in exchange for an interest rate. However, given that interest rates have been incredibly low in recent years, they had to take on more risk and extend the duration of these loans to achieve an attractive yield. As long as savers don't demand their money back all at once, there's no problem. Banks always keep some liquidity in cash to meet occasional requests. However, if everyone wants to withdraw their money at the same time and the bank has to sell its treasury bonds before maturity, then it becomes problematic, especially if interest rates have risen in the meantime. Again, as I explained last time, if you lend, let's say $100 to the US government at 4% per year for a duration of 12 months, you now have a treasury bond with a face value or principal of 100, a coupon of 4, roughly what you earn at the end, and a maturity of 1 year. This piece of paper can be traded on the secondary bond market. Now, if a few weeks after you lent that 100 to the US government, the feds raise interest rates, now governments are no longer paying 4%, but 5% per year for the same type of loan. Automatically, there will be fewer sellers for your little piece of paper because there are new bonds with more attractive rates available in the market. That's why the value of bonds on the secondary market values inversely to the yield curve. It's one of the key concepts to understand the current situation of the financial system. The rise in interest rates has devastated the balance sheets of U.S. banks, and they are now in a very complicated situation because they have bonds on their balance sheets that are worth less in practice than what they owe to all their clients. Some may think that the worst is behind us. It's true that SVP and Silvergate collapsed a few weeks ago, but U.S. authorities intervened very quickly to calm everyone down and reassured savers that there's no risk of contagion. They implemented yet another assistance program with another name, the Bank Term Funding Program, BTFP, a mechanism that allows deposit-taking institutions to obtain loans with a term of up to 1 year in exchange for pledging treasury bonds and other securities. The pledged securities will be valued at their face value, not the market price, which avoids forced sales in the event of market stress. Let's be clear, it's disguised quantitative easing. But with that, the wall is starting to crumble. The system cannot survive with such high interest rates. The pain threshold that Richard often talks about has been crossed. Now it's the First Republic Bank that's in turmoil. Over $100 billion has reportedly been withdrawn from the bank since January. The stock price of the 11th largest deposit bank in the U.S. has lost almost 95% this year. On Wednesday, financial authorities even decided to halt the trading of its shares due to apparently excessive volatility. On Friday, Reuters reported that U.S. financial authorities once again took over the First Republic Bank case to prevent it from crashing and taking everyone down with it. In my opinion, we haven't seen the grand finale yet. We haven't witnessed the truly sensational bankruptcy of a much larger institution that the whole world will be talking about. At the end of the year, the funds of the FDIC, which are supposed to guarantee U.S. savers up to $250,000, amounted to $128.2 billion, while there is currently $17 trillion in deposits in U.S. commercial banks. So almost 100 times more.
This is Houston. Say again, please.
Houston, we have a problem.
It's always the same thing. The falling dominoes are getting bigger each time. SVP was the 17th largest U.S. bank. We're now almost entering the top 10 with First Republic Bank. In 2007, the contagion started with American Home Mortgage and New Century. A few months later, the fall of Bear Stearns followed. Yes, Bear Stearns, the 5th largest investment bank in the United States, collapsed, followed by the case of Lehman Brothers, the 4th largest. And the pyramid would have continued to crumble if the U.S. government hadn't intervened. But what's happening right now in the U.S.? It's pretty straightforward. All American savers are withdrawing their money from smaller banks and putting them into larger ones. Why? Because if your money is in the hands of JP Morgan, Citi, Bank of America, or Wells Fargo, you know they will never go bankrupt because they are too big to fail institutions, also known as systemic banks. You can check the details on Wikipedia if you want. On the other hand, the few days of hesitation and debate over providing assistance to SVP, which was not a systemic bank, were already too much for people. Why take the risk of staying with a small, local bank that could be sacrificed when you could simply, with a few clicks, transfer your assets to a much safer institution? And this phenomenon is not new at all. We've been witnessing an extremely unhealthy concentration in the banking sector for over 20 years. That's a problem that 95% of American banks find themselves in. It's a bank run 2.0, caught between their clients demanding their money and the Fed continuously raising interest rates, significantly impacting the value of the assets they hold in reserve and would be supposed to sell to regain liquidity. For Balaji, the situation is catastrophic. American banks are already largely insolvent, and the authorities themselves are well aware of this. According to him, essentially, everything is on the verge of imploding, and it has already begun with the banks. This situation is expected to lead to such massive money printing that it will propel the U.S. straight into a hyperinflationary spiral. Well, I don't entirely agree with him on that point. The US is not the Weimar Republic, Venezuela, or Lebanon. Entering a hyperinflationary loop requires not only a significant amount of money in the economy, but also a period of extreme scarcity of goods and services, which typically occurs in a country at war, in revolution, or with an economy heavily reliant on a single product and having to import everything else from outside. So, we should be cautious with such generalizations. A situation of hyperinflation in the United States or a European Union country remains unlikely. However, yes, we do agree that central banks are on the verge of ending monetary tightening and that the printing presses will start running again. As we discussed earlier, this is already partially happening indirectly through the Bank Term Funding Program. In fact, the markets are betting on a 200 basis point reduction in the next 18 months. We have witnessed the fastest rise in interest rates in history since last year. It's highly likely that we'll also witness the fastest rate cut in 40 years. The junkie needs their fix to avoid dying. And like any good addict, the dose needs to be stronger than the previous one to achieve the same effect. The quantitative easing of 2008 and the one during the anti-COVID measures crisis will probably pale in comparison to what we'll see in the coming years. So, hyperinflation is unlikely, but an economy with an official inflation rate of around 5%, that's almost a given after all. And if the official number is 5-6%, just imagine what it's really like at the supermarkets and gas pumps. All the experts were trying to determine how far central banks could go with raising interest rates. Well, we have the answer now. The Fed has hit the wall. They have reached, in a way, an event horizon of a black hole. No one really knows what's on the other side, and most importantly, no one wants to find out. This is the perfect breeding ground for Bitcoin and cryptocurrencies, not only in terms of valuation, but also in terms of rethinking money and the banking system. Returning to the bet we mentioned at the beginning of the video, yes, $1 million per Bitcoin may seem far-fetched, but it's not that absurd when you think about it in the long term. Bitcoin is still a drop in the ocean of financial markets. Its total market cap is equivalent to companies like Visa. It's nothing compared to the project's ambition. If the queen of crypto were to catch up to gold, for example, one Bitcoin will be worth around $500,000. And I'm not even talking about the next step, where Bitcoin competes with other asset classes like stocks, treasury bonds, or even real estate. Human nature is such that we tend to look at things in a linear way. We're unable to visualize exponential trends, which is the case for the growth of all technologies based on the network effect, or Metcalfe's law, internet, smartphones, social networks, Bitcoin, and more. Bitcoin is a distinct asset class that will fundamentally transform our society. Its growth potential in the coming years is difficult to grasp, but one thing is certain: the potential for gains is enormous. Bitcoin is a valuable tool for kickstarting a cycle of creative destruction. It's a lifeboat, an alternative for those who no longer want to participate in the current system as it stands. Bitcoin can be a tool that allows people to vote with their feet. By abandoning these systems where value is distorted, they could potentially collapse on their own. Bitcoin makes sense by offering an escape from state currencies, but it's also the entire movement of decentralized finance that allows us to flee from traditional banks and financial markets. These new technologies are here, and they push us to make choices. Now, the question is whether we're able to use these emancipatory forces correctly.